Hello everyone and welcome to Getting Ready for Collateral Underwriter. This is Vice President of Business Development Jacob Gerton here at CoesterVMS. With the implementation of Collateral Underwriter fast approaching, we understand that there are a lot of concerns, anxieties, things of that nature going into this coming week, and we just wanted to provide some insight and things of that nature. Brian has prepared a pretty insightful presentation for the webinar today. He'll go over briefly just the functions and purposes or intended purposes of CU, which are already pretty well documented by Fannie Mae, and then he'll primarily focus on just the potential implications, business processes of this update. We do request that as the presentation commences that you submit any questions regarding the presentation within the question pane on the right side of your screen. We will address those questions as time permits at upon finishing the presentation. So we will have those logged. We will try to address as many as possible. We appreciate everyone's attendance today. So without further delay, here's Brian Coester.
Well, thank you, Jacob, and I thank you for the introduction. You worked a lot on the implementation of CU for us and dealt with a lot of clients and vendors. What do you think?
I mean, first off, there's going to be an inevitable transition period. I foresee it being at least 60 to 90 days, and this is going to be at all levels, from the lender to the AMC to the appraiser. It's going to be similar to the implementation of the UCDP. It's just going to take some time for everyone to really get their processes in place. Long term, I really think that this will bring more consistency, bring more accuracy to the appraisal process. I've been on a lot of the webinars that Fannie Mae has put on, and I don't think the intention is really to say that this appraisal is right or this appraisal is wrong. It's really to give the lender the ability to say, okay, there's information out there that says this may or may not be a risk to this particular loan. And it will give them the ability to go back and not necessarily question the appraiser's expertise or their opinion, but really open up the conversation between the lender and the appraiser, obviously with the AMC as the facilitating those conversations.
Gotcha. Yeah, that makes a lot of sense, and we appreciate all the work you've done to help us get through this and work with all the clients and appraisers and everybody. So thank you. And everybody. We have a lot of people on this webinar. There was probably a little over 500 who registered, and then people are coming in. So that's why we're taking a little time getting going. But we're going to go ahead and get started, and just to kind of frame this, guys, for you when it comes to getting your answers. And we had a ton of questions, a lot of positive feedback, a lot of negative feedback. But the overall is that CU is a big mystery when it comes to the actual implementations of it. I was on a call with the American Bankers Association last week and talking to their bank members regarding the implementations of CU and answering some of their questions. And there's just a lot of questions out there. And I don't even think, when it comes to answers, a lot of people are going to Fannie Mae for the answers. And I don't even think Fannie Mae has the answers when it comes to what the long-term implementation or long-term changes of CU will be. And a lot of it has to do with just the fact that you're dealing with mass data, you're dealing with algorithms, you're dealing with big data, you're dealing with very subjective points of view, and seeing how it all kind of comes together is something that they're unsure of. And so the vague answers, the questions that, kind of are boilerplate questions, that's something to be said of that they really are going to see how this is going to happen. They have a general idea, which I think we're going to go into, and we're going to go into how I think it's going to affect your processes. But at the same time, you know, they don't necessarily 100% know, and that's just from what I've been able to gather. So just a little bit of background. Collateral Underwriter has been in the works since the early 2000s. This is something they've always been trying to do when it comes to the appraisal process in a variety of levels. And this is something that they've been doing on the back end. So the idea of appraisal, you know, reviewing appraisals against other appraisals using mass market data, scanning appraisals and capturing that data is something that they've wanted to do for a long time. It gets delayed by a boom, gets delayed by a bust, but it's something that it's been in the works for a while, and to a certain extent they've already been doing this to a lot of your appraisals for a very long time. And so this Collateral Underwriter tool that is now coming out is not like, it's new to the lending institution, but it's not necessarily new to the industry and on the back end. This is probably going to be the most significant change to the appraisal and mortgage lending industry in the past 5 years. And when you look at the HVCC and how that changed appraisal processes, appraisal review processes, the lender setup, they had this explosion of appraisal management companies and the restructuring of the relationships. When you look at UCDP and the way that shaped and changed the industry with the XML data and how all the lenders were now required to get registered, and then also the sudden explosion of the data available. This is probably going to be bigger than that. And the reason I say it's going to be bigger than that is because the entire way a lending institution is set up on a reviewing appraisals is now going to have to change. And then for the foreseeable future is going to remain in that new capacity. So the idea of, you know, doing it another way, the idea of using your own software, the idea of not using the system doesn't seem to be something that is going to happen over the next couple of years. This is going to be similar to the implementation of Desktop Underwriter. So if you look at, if you were an underwriter before DU and then after DU, you would realize that everything's changed. That now you have, you're working within a system, you're within a system that has rules. Those rules change all the time. Those rules change based on a variety of factors that you don't know. It's now a moving target. Everyone has to be trained on the system. That training and ability to troubleshoot that system and skill set is now a marketable skill. I think Collateral Underwriter is going to be very similar to that. You know, Fannie Mae, with their, you know, his objective is to offer full reps and warrants on both the credit and collateral. So the idea is that you get DU and CU approval, you get full reps and warrants. Again, that always comes with, you know, a million lines of disclosures, but that's the general gist of it. So what is CU? It's a national database of every appraisal completed in conjunction with a Fannie Mae loan. Basically, you know, the 50,000-foot view is they scan every appraisal they've ever done or ever have access to, they're able to be scanned, and they created algorithms and scenarios to compare the appraisals to each other to see if there's something wrong. So traditionally, when you look at an appraisal review, it's based on just this appraisal versus market data, MLS data that's available. With CU, it's this appraisal against all the other appraisals that we have, plus market data that's available. With the, you know, peer consistency, with the adjustments, with the ability to look at contextual analysis of what other appraisers did, and then with the historical market data being something that has never been available. And CU is model-based rather than tool-based. If you look at most traditional QC systems, they're like a checklist form, you know, plus or minus 5%. Comparables are, you know, 3 miles, 2 miles, which is outside of the normal range. And they're just a tool. This is actually a model. Well, they'll give you contextual analysis of the specific market data and they created algorithms to track associated risk and associated inaccuracies with the idea to get the most accurate contextual appraisal possible. What CU will do, provide a contextual analysis of the appraisals, review appraisals against their peers, find inconsistencies with the appraisers' reports. Competency will be accounted for. And when you see the find inconsistencies, that's something that is still going to be, Fannie Mae has acknowledged and publicly came out and said that there's going to be false positives and false negatives when it comes to CU findings. And so what they're doing is saying, okay, well, if they have another appraisal that says that this house is 3 bedrooms, and then the second appraiser comes out and says this house is 4 bedrooms, well, now you're going to have inconsistencies, and that'll flag a CU finding. At the end of the day, you know, somebody's wrong, and that decision of whether that first appraisal or second appraisal is wrong, you don't really know. I mean, you can obviously go back to the first appraiser or go back to the second appraisal and ask for clarification and stuff, but that's where they'll be able to do. A lot of times as an appraiser, and I'm actually a certified appraiser, you'd have situations where the borrower would say, you know, the appraiser missed the bedroom in my basement. It says I have 3 bedrooms. I really have 4, and then they just don't look at it. They don't look at the one that was marked as a bedroom in the basement. This is similar to that in the idea, but this is just against other appraisals. And so the idea is you'll have kind of a proactive contextual. The trail of appraisal revisions will be documented, and both lender and appraiser quality will be contextually compared. And that lender, I would really focus on that lender and appraiser quality will be contextually compared. Meaning, if you're a lender that does a lot of new construction, and you know, new construction's notorious to being a little outside the normal market because they're trying to build a new, you know, subdivision with a new set of market data that's bigger and better. That's what builders do. It's normal. I would be careful to make sure that all of that is really documented. This is a new subdivision that all the comparables were properly documented. Everything was just right in a row, because they'll be able to say, okay, well, this lender, for some reason, all of their appraisals come in 10 grand higher than the subdivision, in the same subdivision for another lender that's doing appraisals in the same subdivision. So we have 500 appraisals that average $300,000 in this subdivision in Texas, and we have 500 appraisals from another lender that average $330,000 for the same subdivision. And they can break that down to appraisers, they can break that down to various lenders, and figure out if there's any trends associated. And that contextually compared is something where you really have to account for the type of business you're doing, how that matches up against other lenders, and something to be considered. So the biggest, if I was going to say the impact to your business as a lender, the biggest impact is going to be the CU, is reviewing the CU appraisal risk scores, flags, and messages. So if you look at the way that CU, and we're going to go through it a little bit, they're not going to tell you what to do. They're just going to kind of tell you the risks, the warnings, the messages, and that they found something wrong. What you do with that is up to you. They're not telling you specifically what to do. And so as a lender, if you run into a situation where you do an appraisal, let's say in the DC area, and the appraiser puts $110 a square foot for adjustments, which is, let's say, normal in the DC area, and they upload it to CU. DC area is a very complex area. CU comes back and says the adjustments are out of whack. You know, it seems that their adjustments per square foot are overinflated, and the average market data is 65. per square foot. You then go back to the appraiser and say exactly that. CU says it should be 65. Appraiser comes back and says, well, first of all, so this is where you got to think about it. They already have a copy of the first one. So if the appraiser comes back and changes it now, then they have copies of both. So that doesn't look good. And then secondly, when the appraiser comes and says $110 is justified, here's the associated market data, because they should have that in their work file, to support $110 a square foot. When you upload that file to CU, that warning flag's still going to be there. And so as a lender, you're going to have the confidence and then the competence to say, we know that CU identified this issue. We properly mitigated that risk, and we're okay with it. So we know the market. We understand the risk associated. We understand the warnings, and we're okay with that. That is going to be, I think, the pivot and kind of the hardest part for most lenders, is creating an effective process to handle that. Because you're going to need a talent at some level on site to say, okay, we're okay with this, we're okay with that, we're not okay with this, we're not okay with that. I understand the market. That appraiser explained that properly. Because these warnings, there's going to be a lot of false positives and a lot of false negatives. So being able to handle that. If you look at the traditional, I would say bank model, or the older traditional bank model, where they, do lending in a couple counties. They have a chief appraiser that reviews all the commercial, all the residential, that sits on staff, on site. They do, 30, 40, 50 loans a month. And I see these, we have a lot of clients that are like that. They're fairly well equipped to handle this because they're only lending in a small geographical area. They understand the market. They understand when they're lending. They have this expertise on staff to handle it. And this won't be that big a change. When you talk about national lenders or national wholesale lenders that really don't have local market knowledge, creating an effective review process to override those hard stops is going to be difficult. Now, Fannie Mae's position, and here's the fun part. Fannie Mae has been doing this on the back end anyway. So it's not like this isn't already happening. What they're just saying is, now this is your responsibility of something that you should be doing all along. So they expect you to check all this market data. They expect you to properly review the appraisal and ensure that it's accurate. So it's not like, from their perspective, this is a big change. For most lenders, this is a very big change. Now, we go and meet with clients and I travel around, and I'm sure some of the people on here I've met personally. I like the setup of the appraisal underwriters. The idea of having a chief appraiser and a couple appraisal underwriters to manage, to review the appraisals, and the idea that you have somebody who specializes in the appraisal process, somebody who's an appraiser or former appraiser or an underwriter who can really dig deep into the appraisals, and then somebody who kind of handles the initial, CU findings, maybe sends it back to the appraiser. That could even be outsourced to an AMC. If you guys use AMCs, that initial review. But when it comes to the override of the hard, meaning that somebody's make a decision for the lender that we're okay with it, that's going to have to be done at the lender level. And simply, there's a risk associated with that you're saying we're okay with it, you're overriding it, you're requesting an override code, you got to put a reason, and there's just a whole host. So just something to think about. Like I said before, most lenders and banks are not equipped to handle CU and the manual overrides. The reason codes will impact eligibility of loans. And this is something that, I've heard some rumors, let's just say, rumors that, if you get enough hard stops, there's going to be associated fee, in the idea that they're going to charge you more for that particular loan if you get a certain amount of hard stops to offset the risk, and then it will impact the eligibility of your loan. But that's not necessarily, directly from Fannie Mae. Here's an example of some failures, and this is sourced with Fannie Mae, but this is just some examples of what you would see. Research prior sale, less than 3 settled sales were used as comparable. Some of these are very basic. Legal non-conforming. Fannie Mae will not accept appraisal from another appraiser, appraisal supervisor. Quality issues, but there's like hundreds of reasons, and you can find them on their website. But the idea is that you will be looking at these reason codes and then either overriding them or accepting them. Things like warning, there's a heightened risk for overvaluation. Warning, there's a heightened risk of property eligibility and or policy compliance violation on this appraiser. If you look at some of these, the property rates or leasehold fees will ensure the appraiser corrects the data. In other cases, the property is eligible for delivery. Things like that. The collateral underwriter risk score is 4 on a scale of 1 to 5, where 5 indicates the highest possible collateral risk. You're going to have to be dealing with. Now, some people say, well, we'll just copy and paste the whole thing and send it back to the appraiser, and we'll have the appraiser deal with it. The problem is that when you re-upload this, the same warnings are going to be there. So it's not like the appraiser, adding another comp or adjusting is going to make that big of a difference. So it's going to be something where you have to look at this and say, okay, I've looked at what this has given me feedback. And I'm okay with this. Now, some of this can be outsourced, right? So as an AMC, some of these reviewing these messages, we have appraisers on staff. When we upload these, we can look at the warnings and kind of say, okay, well, this one's okay, this one's not okay. We can have the appraiser address these. So there's a level of, you don't have to have, but ultimately, when it comes to overriding specific things that are associated with with failures that you're going to have to put an override code into, that's going to be the lender's decision. You're going to have to be willing to make that call or order another appraisal, get a desk review, or something along that line. I don't know. Hold on one second, we got a little background noise. Going on here for a second, guys. Hold on one second, guys. I don't know what happened. We had a little background noise. So you're going to have to confirm the appraisal meets requirements and risk associated. Okay, sample review process. So this is just a sample process that I put together that's internal. This is directly ours, where the appraiser is going to upload the file, reviewed by quality control to make sure that it meets the basic structure of a quality appraisal. Send it to UCDP, and then there should be warning flags. If there's no warning flags, everything looks good, then we'll deliver it to client. If there's yes, so then you're going to need to send it to a reviewer or review appraiser for interpretation. Now, if there's overrides, this is where the fun part is, of certifying the accuracy so that is this appraisal accurate? Is it not? Am I okay with this inaccuracy or this inconsistency? If not, and this is where it's going to be kind of interesting, where if it's not okay and you're not okay with it, they're going to want you to adjust the appraisal or reorder your appraisal. But ultimately, I mean, the adjusting the appraisal, I'm not necessarily 100% for all the time, because I mean, obviously you can put some comments and stuff like that. But because when it comes back around a second time, I'm fairly certain the same warnings are going to be there. And so most appraisals, when you look at it from an appraiser perspective, there's really not an issue with the appraisal. There's really an issue with the appraisal not fitting into the box, the comparables not being right to fit into the box, some of the inconsistencies associated with the market area, and that's a complex property. So it's really not we used to always have this kind of joke in the appraisal industry where it's really not an appraisal issue, it's an underwriting issue. And the idea the underwriter doesn't like it, but there's nothing else available. And what you'll see, I think, a lot with CU is that issue becomes more prevalent, more relevant, where you have a lot of CU failures or CU findings that say there might be some inaccuracies when the appraisal is fine. And if you had another local appraiser look at it or another appraiser look at it, they would say it's fine. And getting that comfort level with saying, okay, we've looked at this, we've looked at this, and everything seems to be okay, is going to be something where I think the lenders are going to require to adjust to. Problems I foresee. Some of the GSEs free range to control what's good and bad. So the GSEs, or Fannie Mae, has removed their appraisal guidelines. So that whole 5%, 15% net, 25% gross adjustments, comparable within 1 mile rule. I mean, within 1 mile suburban, 5 miles rule. The whole kind of general guidelines. That appraisers and underwriters review. They go down the checklist. As long as everything in the checklist meets the requirements, you got a good appraisal. That is gone. And what they're saying is, we'll take the appraisal because we're comparing it against all the other appraisals, but we just want a contextually accurate appraisal. Well, that becomes a little harder. If you're setting up a business process, you want something where if it doesn't meet the initial checklist, it goes to a level 2 review, and if it doesn't go to past level 2, then it goes to an actual subject matter expert who can really dive into things. That eliminates a lot of the 1s and 2s, and it really just says, okay, it goes to CU, and then somebody needs to be able to interpret this information. What's good, what's bad, what's acceptable, what's not. So removing the guidelines, but also now these guidelines are going to be, or this interpretation is going to be forever changing. If Fannie Mae decides to change some quality issue in Texas, they could do it without anybody knowing about it, and they could just say, we don't like these loans in Texas now, and every file is going to get a CU finding on this file, on this area in Texas. If they decide that this area they want to loosen the appraisal and CU findings, they can do that, and it's free range to control what's good and what's bad. Whereas before there was a lot more published guidelines. That's both good and bad, because I think a lot of times appraisers used to write the appraisals with the guidelines in the back of their mind, but at the same time, to me, that's a major issue. The secretiveness in which this is being done, I think, is an issue. There was a third-party service provider that helped Fannie Mae out a lot with some of the UCDP stuff, as well as there was other third-party service providers that were very involved in some of the processes, and that is something that they have not included, from my understanding, with CU. So this has been kind of their little pet project, and then there's kind of implementing it across the industry in a couple of weeks, really next week this time. And there's really no guidance on how EMCs are going to handle this. Luckily, we have some clients that are on the pilot, and so we're able to kind of dig through some of these issues quicker. But also no implement guidance on how the appraisers in the appraisal industry is going to handle that. I think that is a major issue. Now, hopefully, if they roll this out properly, which to me would be over the next 6 months, slowly start increasing the warnings, slowly start increasing the findings, slowly start doing those types of things. It won't be as big of an issue, and then they get given AMCs access to it as well as appraisers access to it. I think appraisers should have access to it at some level. I understand their position, but it would, from a business process standpoint, it just makes a lot of sense. And then also I'd expect an increasing processing and underwriter time. If I'm a lender, I would expect a major increase in processing and underwriting times on the appraisal. And the reason I say that is because you're seeing, something that has been done in secret that nobody has access to, none of the data is publicly available, that's going to find all these problems with the appraisals that you have no way of foreseeing, and now you have to go back and correct all of them, and then have somebody sit there and override the ones that, you couldn't get an answer to or that were warnings. That alone could cause a process. I think there's going to be some appraiser backup. There's a USPAP issue when it comes to the appraisal process. One of the issues is that they're reviewing appraisals against appraisals, reviewing appraisers' appraisals against appraisals that the original appraiser didn't have access to that data. So if you're saying, that I should have used this comp, or if you're saying that my square footage is wrong, or if you're saying that my price per square foot is wrong, you can't tell me that after I did the appraisal and said you had access to all this data that was not publicly available and then hold me accountable to it. The entire appraisal process is designed to protect the appraiser against that. And USPAP, it says, okay, all the information has to be publicly available so that all your peers, meaning the entire industry of appraisers, has access to relatively the same amount of information, so that if there's ever an issue, you can say, okay, what would your peer do in a similar situation? Well, if Fannie Mae is coming back with all these warnings and all these deficiencies on appraisals, and you said, well, there's 5 other comps that were sold on new construction that you should have used, well, appraisers are going to say, I didn't have access to that. I didn't have access to those other comps, or I didn't have access to that market data, or I didn't know there was another appraisal that said that this comparable was 1,400 square feet. So there's an enforceability issue, but also a potential USPAP issue. And then also that this is not the final word in appraisal quality. If you look at, the way, DU or the CU, DU findings, when you get kind of a DU approval, a lot of lenders kind of say, okay, well, it's approved. If you get the CU, say approval or low risk score rating, that means that they just didn't find data in that area that said there'd be something wrong with it. That doesn't mean that there's something not. That doesn't mean there's not something wrong with it. So that's something where this is kind of deceiving, where I could really easily see a lender say, okay, well, we got the CU approval. Let's do the loan, and the appraisal's horrible. Because remember, they've removed the guidelines. So it's not like they have these guidelines that these appraisals have to be done to. So an appraisal could have, 50% net and gross adjustments and could be great, and then the appraisal could have 1% net and gross adjustments, get no CU findings, and be a horrible appraisal. And so it becomes kind of an open ball game. Benefits of CU, full reps and warrants on DU and CU approvals. Again, contact Fannie Mae about it. This is just what I've heard. Appraisal accuracy, consistency will increase, consistent scoring. And the consistent scoring is big. When you look at, if I was a lender and there's a lot of companies and third-party companies that have tools that do appraisal reviews, appraisal analytics on appraisals. They give the appraisal a score, and there's half a dozen or so, and they all have their different score. They all have their different metric. They all have their different way of doing this. Those, if I think those are going to be pretty on the way, pretty much gone within 5 years. And the reason I say that is because if Fannie Mae, if Freddie Mac, if FHA adopt these CU, which I think they will eventually do, why else would you need a third party? Because everyone, you obviously want to show that your quality is good against your peers, and if everyone's using this tool, then ideally you would have the same thing. I do think there's still going to be a play for lender specific, because even though Fannie Mae is going to have a system of scoring across the industry, there's still investor-specific overlays that I think need to be accounted for, which a third party, and we're incorporating those into our air product. But a third party could make sense. But the consistent scoring is going to be huge. The training, when you think about a skill set, if I was hiring underwriters or appraisal reviewers, the ability to be trained and use CU would be a good benefit to me, and I'd want to hire that, some type of CU certification. And then there'll be a market-specific review process. So, the appraisals are going to be reviewed against other appraisals, and also free of charge, which is also good. If I'm an appraiser, right, and what am I worried about if I'm an appraiser? There's going to be a lot of unnecessary conditions. And that's going to come from just the adoption process. So, I would say, every warning, every flag, is going to be a condition, even though that's not designed to be that way. If initially, I think it's going to be a scenario where, they copy and paste everything to the appraiser that came over. You send it back to the CU. Just the warnings will still be there, or you send the appraisal back in. You're going to need somebody to interpret it, to override it. But at the end of the day, they're still going to be there. And so it's going to cause a little bit more work, more accountability when it comes to what areas. So if I was an appraiser, I'd be a little more careful to where I was accepting work because they're going to be monitoring, tracking all of this. So every appraisal, if you do, only Montgomery County, Maryland, and all of a sudden you start doing appraisals in Prince George's County, which is adjacent county, they're going to start looking at that and say, okay, well, that county, he's never done an appraisal in that county. Or if, you do an appraisal for your friend, 50 miles away, they're going to know that. And so just a little more careful. The rule of thumb goes out the window. So, most appraisers, when they get into the appraisal business, they have a community of appraisers they talk to about what they do, and appraisers kind of say, oh, well, in that market I always adjust like this, and this market I always adjust like that. This market has a premium lot, so I always give them 10% more. And there's just kind of a rule of thumb to what happens when you do appraisal. Some of it is accurate, like you just kind of know, and then some of it is some of it is just market data where you've done enough market analysis to know the specifics of each market. And so in this area is $35 a square foot, and this area is $40. Well, over time, you just kind of get a feeling for it. That's completely out the window. Where I was an appraiser, and we'd always put $3,000 for a fireplace. That was kind of a standard thing, $3,000 for a fireplace. Because how much does a fireplace cost? Between $2,000 and $5,000 to install it, depending on the niceness, but about $3,000. How much would you pay extra for a house with a fireplace? Well, now, if you put $3,000 for, they're going to want market data that supports that. So that kind of rule of thumb, general guidelines, is going to be out the window. There's going to be a lot of unnecessary flags, unnecessary conditions. And, you know, it kind of is what it is. One of the things I would really focus on if I was a lender is that CU is not designed to be a right or wrong answer, but more of a tool to say, you might want to look at this. And when you say you might want to look at this, us as a lender are okay with taking on that risk. So, hey, there's some CU findings, but us as a lender are okay with taking on that risk. And then the only other thing is that some of the stuff when it comes to false positives and false negatives, Fannie Mae had a great example, and I bring this up because just kind of prepare you guys. Fannie Mae had an example where there were 6 appraisals done, and all of these 6 appraisals had the square footage being a certain square footage, and all of them were the exact same for the house. And then there's a 7th appraisal who comes along, and he measures it 200 square feet larger than all the other 6. Well, CU finds this out, and CU flags it and says, you know, this is wrong. Well, so they go through this whole song and dance thing like you normally would, and it finds out that the previous 6 appraisals were completely wrong, and that the 7th appraiser is the only guy who measured it right. And so it's one of these things where even though CU did what it's supposed to do, even though it had a lot of market data, the 7th appraiser was right. I foresee that happening a lot. And that's the impact to the industry that you got to think about, which is because they'll tell you that, addressing it, and then being okay with it. You know, whether that's doing a field review, and that shouldn't happen, you know, on every file, but just getting into situations like that to where you really have to have the ability to make a decision. So now we're going to open it up for questions, and just to tell you guys, so all these slides, this whole presentation will be available on our YouTube channel, to which we usually get up by the end of the day, and then you'll also be able to, you know, be on one of our newsletters. But we're just going to go ahead and open up to questions. We did get a lot of the questions beforehand, so we'll go ahead and just kind of start with the questions that people filled out when you were signing up for the webinar, and then we'll do some of the more Q&As from stuff available. So, all right, let's get into this. Do the appraisers have to include 20 comps on every report? And that is something that the answer is no. So there's something called a regression analysis, which is basically the mass market data, hundreds of comparables, which, you know, provides a very statistically accurate appraisal, but that's not something that the Fannie Mae is required, nor is it something that CU would account for. It's more of supporting documentation. And then when it comes to supplemental comparables on the appraisal, I think sometimes that question was geared towards Fannie Mae is going to offer all these supplemental comparables. Do, you know, appraisers now have to add all these other comparables to have them so that the underwriter doesn't question why they didn't use these other comparables? If I was an appraiser, I wouldn't. I would keep it same, you know, 4 or 5 comps, 2 or 3 listings, and call it a day. Those additional comparables are only going to confuse everything because you can't have that many comparables. And then the more is not better. Well, I would actually lean towards less if possible. But there's no requirements that say that. Can we rely on a regression analysis for an adjustment? Yes. There's a lot of good tools out there. Regression analysis is where you look at mass market data to figure out the specifics of, like, isolating how much a price per square foot is, or how much fireplaces or how much. And there's a lot of good tools out there for that. Absolutely. I don't think it's necessarily going to, if you're doing it right the first time, I don't think it's going to be an issue, but you can absolutely do that. Let's go through the other ones. Okay, I realize that CU is mostly designed to provide clients with additional information regarding the appraisal submitted, but as an appraiser, do we have to submit any additional information in the appraisals? So, Mike, no. I don't think this is going to be as big of an impact to appraisers as most people think. And when I say that, I don't mean that you're going to initially have to do more work, because I do think initially, as a transition happens, there's going to be a lot of work involved into it, but I do think that the appraisal process itself and what you provide is probably not going to change that much. I do think there's going to be a little more questions, little adjustments, but you shouldn't really have to provide any additional information. This is going to be more on the lender side, and the reason is because most of the findings that they're going to find, I think, initially, when I say initially, I say for the first year, are going to be inaccurate. They're not going to be 100% right. They're going to have a lot of gray area to it, and they're going to come back with a lot of warnings that are unnecessary. So there's nothing necessarily wrong with your appraisal. Those warnings are going to be there even if you put a ton of market data in there, because they're reading really just the XML version of the appraisal, not going to read the regression analysis that you attached. They're not going to read all the addendums that you wrote. That's not that sophisticated. So they're just reading kind of the base XML of the 1004. So you could do all that, and it would be good just from a quality customer service standpoint, but I don't think it's going to require. I would expect a lot of changes and a lot more questions, but I don't think it's going to be required. Let's see. Okay, this is a good question. What's to stop AMCs and lenders from misusing the flags, demanding that the appraiser be consistent with the CU model data? Well, and that's a good question. I would hope that AMCs and lenders don't do that. And the reason I would say is because they're going to have a copy of the first appraisal. So if all of your appraisals are now changed to fit the CU findings, how long do you think it's going to know before they figure that out? Because you have to send it in first. So it's not like you have a desktop tool that mirrors the CU findings. So you send it in first, and then you come back with all these warnings. Well, if you just change the appraisal to fit the warnings, and so that you have less warnings, well, they're going to say, well, the first appraisal you sent, did you review it at all? Did you just told the appraiser to change it? I don't think that's going to become an issue, or if it does, I think they're going to hammer down on that very, very quickly. Let's go ahead and so when it comes to cutting the appraiser out, I would not worry about that for the foreseeable future. I mean, when I say that, it's probably at least 5 to 10 years. And the reason I say that is because there is so many regulatory agencies now, and probably 12, I think the interagency rule had 11 or 12 agencies that put up this huge collateral valuation process that banks and lenders have to abide by that don't have anything to do with Fannie Mae's policies, but there's so many regulations now protecting the appraiser that, you know, really, and the appraisers are going to hate to say this, but it really started with the HVCC, that what Fannie Mae was doing on a lot of these non-appraisal orders and loans where they didn't have to get the appraisal and they just waived the appraisal wouldn't be allowed now. And you'd have to actually send out a physical appraisal. So I wouldn't worry about that. This is going to be more of a QC tool, and I would say at least for the next 5 to 10 years, it is possible, and it always has been possible. And but at the same time, I would not worry about that. FHA, VA, and even Freddie Mac, from what I understand, will not be processed through CU as of now. I'm not 100% sure about Freddie Mac. And then when it comes to, this is kind of one more question, but we have a ton of questions, and I'll try to get through as many as possible. When it comes to our personal process, how we're going to be handling the CU, we will handle the CU findings on the SSRs. We currently don't have access to the full version of Collateral Underwriter. Fannie Mae is not giving any access to any AMCs. I have seen it. I've kind of played around with it, but it's not like we have full access to it like nobody does. But we will be handling the warnings on the SSRs, and I would expect, if I'm a lender, that's what I would expect. Whoever your third-party service provider is to do is to say, okay, you run the SSRs, you get the warnings, you address the warnings, send it back to us with all the warnings addressed. Now this is where it's kind of like a handoff to say, okay, we did that. Now you're going to have to figure out if you're willing to take this risk associated. So who's going to override these? And that's where I said that subject matters expert. Laura had a question, will MLS listings play into the valuations? Yes. So they have access to all of that data. Now, when it comes to the real meat and potatoes, it's going to be when it comes to the first copy of when it comes to comparing the appraisal, they're ultimately going to be comparing the appraisal to other appraisals done in that market. And I would really not be so much concerned with the other appraisals done as much as I would be concerned with at least initially. So long term, this is going to change. This is good. This will get you to the next 6 months, and then we'll have another webinar in 6 months, and then we'll tell you what to do next. But initially, you got to be worried about dealing with the warnings and the findings, the whole interpreting the market data and all that stuff against other appraisals and the MLS data and all that stuff. I don't think they know what to do with it yet, and that is, I don't think anybody does. It's a lot of data. It's too much data. Real estate's very specific, and it gets really specific as you drill down to subdivisions where even across the street can be hundreds of thousands of dollars in difference. They know that, and they're not going to be, at least initially, coming back with a whole bunch of warnings based on that. I would focus on, and that'll be something in kind of the CU module that's up for interpretation where it's just there. There's 50 comparables and 50 listings. And, here's some of the ones that we want you to think about. I would worry more about, I would more be concerned with some of the warnings and some of the flags and making sure those are addressed. Because initially there's not going to be that many. Some of them are going to be complicated, and then you're going to need an expert. But I would really be worried about that. When it comes to, and this is the last question because we want to end on time. And we'll do two more. Do you foresee allowing an increased time and fee appraisals for the appraiser due to CU? I wish. This is, one of my big things would be to be able to, charge more and pay more in appraisals. Some of it's just being competitive with the industry and the idea that the appraisal fee does go on the GFE. The appraisal fee is included in a lot of the online engines as a competitive pricing point for the borrowers. It's paid up front, right? So the borrower has to pay that up front. And so sometimes, if one's charging a little less or a little more, it can be a competitive advantage. Right now, the answer is there's no legislative changes or anything, but I would say that I do foresee within 6 months appraisal fees going up a little bit as a result of handling CU. I do think that's a reasonable assumption. It's going to depend. A lot of these are going to be depending on the implementation. And then when it comes to the, have you heard about any of the postponements or to CU and delays? As of now, so here's the thing: they're already doing this. So they've been doing this for months, really years. So it's not like this is the big change for them. They're just more like shifting the responsibility. So all of your appraisals that you've sent to Fannie Mae over the last probably year, 2 years, easily, probably much longer than that, but easily 2 years, have gone through a similar engine, they just haven't told you about the results. Now they're going to give you the results, and it's interesting because I was with a client, on Monday, and he said, he wasn't sure he wanted to know, like where previously you just never hear, you sell the loan off and you never hear back unless there's an issue. Well, now they're going to tell you about potential issues every time, and you're going to be worried about it all the time because you'll see one red flag could mean that a potential buyback when it really didn't mean anything. It was just more of a clarification. From Fannie Mae's perspective, and I can't speak for the company, but they're just saying, hey, you got to do what you've always done, which is verify the accuracy of the appraisal as much as possible. Most lenders have said, okay, well, that's just nothing more than going through a checklist and having an underwriter review it and maybe adding a QC tool or checking some information online. Now it's going to be elevated to having a very robust QC tool that kind of had to have more data and the availability of more data than anything else, and say, okay, well, contextually compared, how does my appraisal now match up? The checklist is irrelevant. The general guidelines are relevant. A lot of the training that most underwriters are willing to look at now are irrelevant, and they're going to be really relying on the tool. I don't foresee them postponing this. I do see them postponing some of the rules. I do see them changing a lot of the algorithms, but that's going to be done on all the back end. And I do so CU, and here's something interesting. CU is not required, and CU is just designed to be used as a tool. Okay, but even though it's not required, okay, it's not required in theory, I would definitely use it. It's an optional tool now, but I would definitely use it, and I would be 100% certain if I was a lender or a bank that within 6 months I better have this process completely handled so that I can effectively manage the risk, because I do foresee a situation where lenders that didn't pay attention to this seriously and just overrode all the ones or didn't properly handle this or just ignored it could run into potential risks. And so that's all the time we have. We kind of start on time, end on time. Thank you guys very much. Here's my contact information. Send me an email. I'll be happy to get back to you guys. Have any questions? We got a ton of questions I wasn't able to get to. We do think that we're going to upload this webinar in full. Will be on our YouTube channel, and we'll send it out. If you guys have any questions, give me a call, send me an email, or if you have any general questions not specific to me, you can reach the company at sales@CoesterVMS.com. Thank you guys so much. We had a great attendance. Hope this is informative, and you guys have a great week.